Nilesh Shah, Managing Director and Chief Executive Officer of Envision Capital, joins us now. Nilesh, good morning. Fantastic to have you back. Nilesh, the general opinion on the street is things are looking bad. US Fed would taper off, rupee has plunged, and Reserve Bank of India has turned hawkish. So the scenario is messy. But in a messy scenario, markets are not cracking freely.
Yeah, I clearly think that that's what the sentiment is. And I think today the sentiment is as bad that everybody's really focused just about on the negatives and really looking at what's happening globally. Now, that's obviously a risk from a 1 to 2 quarter perspective in terms of what the US Fed is going to do, how it basically withdraws from QE, and what's going to be the response of various emerging market countries in terms of their respective currencies. But I think there's a silver lining there. Commodity prices have cooled off. The currency has weakened, which helps export-oriented businesses. And I think the impact on earnings can't be any worse from here. We've just been growing at about 5 to 7% in terms of earnings. I don't think that can get any worse from the current levels. From valuation perspective, we're probably trading at about 13 or 14 times 1 year forward earnings. So clearly what's now in favor of investors is essentially valuations. And I think that's clearly the big silver lining.
Nilesh, just talk about the near term. While we've had to deal with a lot of volatility the past couple of trading sessions, in the next 2 days, in the run-up to the Fed meet and whatever comes out of it, if indeed it's a rollback of quantitative easing that Bernanke announces, is that going to be a really deep negative? Is that going to be a 150 downward take Nifty move?
It's hard to really kind of predict what's going to happen in a session or two, but clearly part of it has already got played out. The fact that we've already climbed down from 6,200 to about 57, 5,800, we've already seen a 10% crack in the markets. Again, on the back of, the US Fed withdrawing from its QE plan. So I don't think that that's yet to play out. I think by and large it's got played out. We might just have one sentimental kind of a hit saying, oh, now it's there for sure, the withdrawal is there for sure, which can maybe drag markets down. But I probably think that that's something which has got adequately kind of discussed, debated, talked, and maybe factored in to some extent.
Nilesh, the chorus on the street is that we could be staring at a new growth cycle very soon. But do you think the marginal change could be disappointing? Yes, the economy could recover, which is GDP could go up from 5% to 5.5%, it could go to 5.8%, but it is unlikely to go back to 6%, which markets are betting on.
Well, my sense is that maybe, 2 or 3 quarters down the line, maybe the next fiscal, we could actually kind of, be going in the territory of 6% plus. And the reason for that is that...
Sounding very optimistic to me.
Yeah, I clearly think so because, look, I think we've got fantastic monsoons. Demand is not as bad as what it is made out to be. You're going to see a lot of things play out in terms of the direct benefit transfers, cash in the money of, in the hands of the households. I think a lot of these things will get played out. And the most important event which I think is going to play out is if what is getting reported in the media that the Prime Minister and the Finance Minister are going to chalk out a significant reforms program, especially in terms of kickstarting the investment cycle. If that plays out, I think that itself is going to be very, very significant. And look, same time next year, the new government, whichever party or whichever coalition heads it, has got nothing to lose by kickstarting an aggressive reform cycle and kickstarting an investment cycle.
I always like when you are optimistic, because when you're optimistic, you give me stock names.
That's a nice way to go down that path, right?
Nilesh, should we pick it up from where we left last time, which is why are you bullish on mid-cap consumer names?
Well, I think... Clearly, I think the growth engine still is sustaining. The fact that India continues to enjoy a demographic dividend and you have an increasing aspirational middle class. And within that, a lot of the mid-tier consumer companies are essentially focusing on certain niche areas where there is really not significant competition from the big players and have a disproportionately high market share, which I think is kind of giving them a much more better revenue momentum, a sales momentum, and continuing to sustain profitability even in a challenging environment. And if you really look at some of the larger consumer companies, they're all trading at about 35 to 40p multiples with growth rates of about 10 to 15%. Whereas here you have some select mid-tier consumer companies which are growing at about 20% and are trading at around 20 times. which I think is a good situation to be in. And as I think with every passing year, the size only grows larger. Balance sheets still continue to be robust. They continue to throw cash flows. And I think, therefore, that warrants a good investment kind of a perspective on these companies.
Nilesh, you've been an avid follower of the IT space. With the kind of rupee weakness, your stance towards the exporters as well, and in particular about Infi and now Narayan Murthy wanting to get back the entire old team of the boys back on board, does it instill any sort of confidence?
Oh, it surely does. I think what it's clearly from this whole episode, what is turning out to be is that the big challenge for Infosys was really the top management's ability to deliver. It's very likely that now they have got a new leadership, so to say, a tried and tested leadership, which clearly has an agenda carved out. So I'd clearly believe that the worst is over for a player like Infosys. I'd probably tend to believe that. Valuations are still attractive. Maybe the first 1 or 2 quarters may still continue to kind of be not very encouraging. If at all, they might even disappoint the street. But I clearly believe that they should be back on track, maybe from the second half of this financial year. And things could go only better for them from here. And the valuations continue to be very attractive versus a player like TCS, of course, which has been, their performance has been commendable and consistent. So I think in that context, I think Infosys clearly offers value.
What about banks? Because they've been a bit of an underperformer the last couple of months.
Yeah, I clearly believe that banks is a space where one has to be extremely careful. The PSU banks, I still think, are still struggling from asset quality. Asset quality is only getting worse, and we really don't know where it will start kind of, improving for them. The big positive for them, of course, is that if interest rates are headed down, then of course they have some gains to have on their treasury portfolio, which could offset some of the asset quality related weaknesses. On the other hand, the quality private sector banks are terribly expensive at 3 times, 4 times price to book. I think they're priced to perfection. But maybe there are select players in between the two, which means maybe select NBFCs or select private banks, which are still today regional banks, but perhaps could kind of, with their branch expansion network playing out, they could become slightly more larger and where valuations are still a lot more comfortable. So maybe that's one pocket to look out for in the entire BFSI space.
What about the 90% of the market? It's only 10% of the market which is doing well. At a time when you genuinely feel that Indian economy could turn around, it could turn around very soon, is it time to focus on that 90% market which is absolutely beaten down and is in shreds?
Yeah, that 90% clearly, by and large is revolving around 4 sectors which, you could call them as trims, which is telecom, real estate, infrastructure and metals. Or you could call them as even tricks where you replace M with C, which is commodities.
I love your acronyms. So, space, trims.
So you could clearly say trim the tricks. So I think that's clearly where, a very large portion of this universe, which is the 90%, which is either cyclical in terms of their core business or are terribly dependent on the domestic economy. I think till the investment cycle does not pick up, till you do not see the Indian economy going back to a 6% GDP growth, or you really don't see big bang initiatives to kickstart the investment cycle, I think that as a segment will continue to underperform. In addition to that, I think apart from the general sectoral risk, I think there could be significant company-related risk. So we're continuing to see a handful of companies engage in huge provisioning relating to their past contracts. And of course, every time you interact with these companies, they say, okay, it's going to get over in 1 quarter. But you see the provisioning and the write-offs getting extended for many, many quarters. So if you're really able to figure that out, that when will this provisioning end, when will the baggage of the past projects end, and when will they start benefiting out of a renewed investment cycle or a renewed pickup in the domestic economy, I think maybe that's the time to really focus on that sector.
As of now, it's not worth the risk.
I don't think so at this stage, because it's quite possible that you buy into something and you could still see the stock price at 20 or 25% even lower. Now, obviously, these could still be kind of mark-to-market hits which you could have. If you maybe have a 2-year, 3-year horizon, obviously it's a good time to look at them. Focus maybe on companies which have clean balance sheets, which do not have debt, are more component suppliers, are more equipment suppliers. I think that's clearly the good segment within that. So maybe probably have some allocation, but look at yet the quality players. It's not yet time to have a risk-on trade in that segment.
Let's start with T then, of trims. Telecom has made a decent move in the last 2 trading sessions. Is it just a technical aberration, or is smart money now getting into telecom stocks?
I think it's a technical aberration. I think it's more a question of the sector getting beaten down and maybe 1 or 2 company specific events which have happened in terms of tie-ups and things of that kind. But I really don't think that this as a sector is going to create wealth in the long term. So maybe it's good from a short-term tactical or a trading perspective, but I don't think the sector merits a kind of an investment position.
Let's understand what is really fueling your confidence for consumer stocks, because the big picture for consumers is not that constructive. Indians are saving less, inflation is eating into their budget, job creation is not happening, and they'll have to pay more for fuel and electricity. So if incremental savings are less, that will only slow down the consumption cycle. If the consumption cycle reverses, then the appetite to consume will only reduce. I'm simply trying to connect dots here.
Yeah, I clearly think that from a very macro perspective, I think that thesis holds out pretty well, that yes, if you are into a consumer business where the categories are very well penetrated, then maybe yes, there is limited growth potential. But I think if you look at individual categories where the penetration levels are still not very high, and these are categories which could be relatively small, I don't think that some kind of a slowdown will have any impact in terms of demand, because you still have a very small segment of the population which is still consuming those products or services, and you're going to see a much larger portion of the population which is aspiring to consume those products and services.
So give me a name now. Give me a name, give me a thought which will sort of crystallize your thoughts.
Okay, so I think one position that we own and we've been liking is a company called Zydus Wellness. This is a company which is again into very 3 or 4 niche segments. So their brands are brands like Sugar Free, Ever Youth, Actilife, Neutralite. Now these are not very large categories today. These are not mass categories where you find that every second person is consuming these. But is there a potential over the next maybe 3 years, 5 years for significantly higher consumption, or these categories becoming bigger? And as these categories become bigger, you will see more players coming in and further enlarge the categories. So I think if you really look at it, can this kind of a company or these kind of segments sustain a growth rate of say maybe 15 to 20% for the next 3 to 5 years? I think the possibility of that is very high. Are the valuations relative to the sector attractive? I tend to believe so, because if you have the larger players trading at about 40 times, these kind of companies are trading at about 20, 22 times, which is a good 40-50% discount to their larger sectoral peers.
But is the stock liquid enough? Because 75% of Zydus Wellness is owned by Cadila. That's locked up.
That I think will continue. I think that's a big challenge in the entire sector. So right from an HUL, ITC to Asian Paints to the smaller players, all of them, the promoter ownership is more than 50% on an average. So that will continue to be a challenge. So you've got to look out for a bad day or an attractive price point to get in.
Stock is up 74% in last 1 year. You still like it?
See, if you really look at it, I think over the last 1 year, but over 2 years, it's flat.
Yeah.
Okay? So over 2 years where HUL and ITC have doubled. Okay, so from HUL going up from 300 to 600, this stock 2 years back was say 650, 700. It's still 650, 700.
What about the richly valued names though, the obvious ones, Jubilant Foodworks, TTK Healthcare? Is the dream run over for these names?
I wouldn't say the dream run is over, but I clearly believe that all these stocks have had a good run over the last maybe 3 to 4 years. And that run was on the back of some of these companies kind of growing at much, much faster pace. So, for example, say Jubilant Foodworks was growing was having double-digit same-store sales growth. Now, that's coming down to single-digit same-store sales growth. So, obviously, there's now a changed growth trajectory for some of these individual companies, and that will warrant some kind of a PE contraction. So, from maybe a 50 PE multiple, you could see these companies come down to 30, 35 PE multiples as well.
So if I have to summarize our today's interaction, your view is that markets have bottomed out, economy has bottomed out, and the trajectory is headed higher, and your big idea is Zydus Wellness.
I'd probably reframe it that I think the economy has bottomed out.
Okay.
I think the markets may still have a little while to go before they bottom out, which means that you could still see a 5 to 10% correction depending upon how things globally play out. But economy, I clearly would believe that it's bottomed out at 4.5% growth, at inflation at 9-10%, and with CAD numbers, etc. I think that portion of it, I tend to believe that's bottomed out.
Are you fully invested?
No, I'm not. We are not fully invested, but yes, I think we are
almost there.
But we are trying to get there.
So you want to be buyer on every decline, unlike what you told me last time that you wanted to preserve some gunpowder.
I think that is a strategy which will continue to hold because we're not yet in a bull market. You know, I probably still think that we are still in kind of a bear market, but we probably think it's still a good idea to preserve some gunpowder, and when the cycle turns, you want to be there.
You know, every time we've interacted, you've given me 2 stock ideas. This is an anniversary week, so you're going to make it special for our viewers.
No, I think, okay, one I've already talked about. I think we still like the mid-cap IT space. Okay. And within that, we like Persistent. I think it's got a differentiated business model. Valuations are very attractive. It will be a beneficiary of the dollar strength. So I clearly think that's an idea which we like. We own that idea as well.